But yeah, what are some of the benefits of using, debt to invest in shares, essentially?
Yeah, I mean, look, the main one is probably the most obvious to people is that it gets to magnify your position. Using the example that you were talking about, the original scenario, someone's got $100,000 worth of shares. You then borrow against that. And
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again, back on the radio waves.
Andrew, we are back again. We say it week in, week out, favourite time of the week. This episode is going to be awesome. Absolutely love this one.
That's what we say every week.
We do say that every week, but...
And we don't lie.
We don't lie. They just keep getting better and better and better. So this is episode 205. We just keep pushing it and bringing more value and benefit to our listeners and our viewers. So
Andrew, continue inflating our own egos.
There's a little bit of that as well too, but that's part of the fun, right? So Andrew, let's get into it. What are we talking to everybody about today?
Yeah, so today we're really, I think now that interest rates have started to go down and now that, maybe debt isn't as expensive as what it has been sort of maybe 6 months ago, we're starting to now get asked some questions around margin lending. We're starting to now get asked some questions about, hey, do I start to utilize debt for investment purposes? So thought it'd be a good time to jump back on the podcast and talk through what is margin lending. Can it be useful? Is there a use case for it? And what are some of the things that you need to consider?
Yeah, and I think not only are we seeing this more and more so simply because interest rates have gone down, the game has changed. The traditional game of wealth creation, especially when you think about cost of living and cost of property and the barriers to entry to get into property, it's not as easy and as simple as what it used to be. It used to be that, even on an average wage, you could afford to buy a property, the property would go up in value, you'd borrow it, you'd pay it down over the time, you'd borrow against it, you'd buy an investment property and you'd sail off into the sunset, so to speak.
Yep.
That doesn't exist anymore, and people are recognizing that the playbook has shifted and changed from the previous generation, that they're seeing that what their parents did no longer is the same recipe for success that's available to them. So they are asking questions about, okay, what else do we do and how else can we help ourselves to grow our wealth? What are some of the tools available? So margin lending is definitely something that we're seeing a lot more of. Andrew, I guess the headline differences between margin lending and I guess some other type of loan or gearing structure, really we're talking about a product perspective here, but what's the main differences? What are we looking at?
I mean, the main difference between margin lending is the security on a margin loan. So the thing that the bank has to be able to bring back as collateral or take as collateral if you don't make repayments or if there's certain things that happen, is a portfolio, usually a portfolio of shares or managed funds, or shares and managed funds. So the main difference between a margin loan is that the security is let's just say for, easy speak, a share portfolio, as opposed to where you'd consider property, the security is a property. Now, to really break it down in layman's terms, when you borrow money to purchase a property, bank looks at the value of your property and they'll give you, let's say, a percentage in LVR, which will break down. So 80% of the funds, let's say, to be able to purchase that property. In a margin loan, operates effectively the same way, maybe at different LVRs, but a bank looks at it and says, hey, Billy, you've got a share portfolio of, let's say, $100,000. You want to invest some additional funds. We're going to give you another $100,000. So you're going to have $200,000 to invest, and we're going to give you $100,000 debt. But we have security over your initial $100,000 so that if something or over the whole $200,000 portfolio, so that if you don't make repayments, then we can come and take that $200,000 share portfolio. Exactly the same thing as property. The only difference is that you're now utilizing debt to invest in shares, and the security is, let's say, shares, as opposed to the security being a property.
So the benefits of doing something like that, let's just get really, really down in the dirt here. If you consider, and let's use property as an example, because that's the one that most people tend to resonate with, but you go and sign on the dotted line for a mortgage of hundreds and hundreds and hundreds of thousands of dollars, and it's quite limiting in terms of how much you can borrow based on your income, based on your deposit, and then obviously what does that look like? Whereas if you're buying a property under that scenario, you may not have the funds to get into the property that you want. So you might look at it and say, I don't have enough money to be able to do this. With a margin lending loan, you can leverage small amounts. You know, you can almost choose, well, you can choose your own amount, and you can get into magnifying a share portfolio by increasing debt, by increasing leverage, by increasing gearing for much, much smaller amounts of money. So when you look at the two, you're still using debt to help, and we'll talk about some of the benefits associated with it later, but you're using debt to help grow your position or accelerate your position. You can do it much, much easier because the barriers to entry in terms of what you can then purchase is a lot lower. And you can do it with small amounts of money. And it also gives you the opportunity to get comfortable with debt, as opposed to, say, a first-time home buyer. All of a sudden you've signed on the dotted line. Yesterday I don't have any debt. Today I've got $700,000 worth of debt. It's a big jump going from 0 to 700 in this hypothetical example.
Yeah, exactly right. So I guess it's basically another avenue of utilizing debt to invest. It's just you're using it in a different way. I think that, you know, maybe some insights or how we could maybe start to give some insights is, you know, what are the benefits of, you know, a share portfolio other than obviously, you know, what you've already mentioned. So you're purchasing or you're doing it with, let's say, lower amounts. So maybe your, you know, overall debt level doesn't substantially change in that, as opposed to, like, let's say, an investment property. But yeah, what are some of the benefits of using, you know, debt to invest in shares, essentially? Yeah,
I mean, look, the main one is probably the most obvious to people is that it gets to magnify your position. You know, using the example that you were talking about, the original scenario, someone's got $100,000 worth of shares. You then borrow against that, and then you double your position. So you've now taken $100,000 of shares, and you've gone and then doubled that to $200,000. by adding $100,000 worth of debt. So your total portfolio now comprises of $200,000 worth of shares, as an example, using shares as the vehicle. $100,000 is equity, $100,000 is debt. But what's happened is you've gone and doubled the size of your portfolio just like that. So that's probably the main one that resonates with people, is it gives people the ability to magnify or increase their portfolio. And then when you look at it from a return perspective, if the portfolio and the markets are going the right way, it gives you the ability to magnify your gains. So you get to experience a greater level of absolute growth because the pool of money that you've got invested is larger.
Yep. So let's say, you know, put some numbers behind it and say, in that scenario, you compare and contrast the two scenarios and say, all right, let's say on the margin loan, or without a margin loan, $100,000 invested, 10% rate of return, you know, we've got $10,000 in additional assets at the end of the year. You then say, okay, we take out a margin loan, and let's say you put that $200,000 into markets because you've now used $100,000 for of debt through a margin loan facility. You now have $20,000 in additional assets. Yes, you've paid some interest along the way, and maybe, you know, the interest rate on the margin loan, which we'll talk through, but maybe that's, you know, 7 or 7.5 or whatever that interest rate is. So $20,000, less, you know, $7,000 in interest. You're now $3,000 better off in that year, having used the margin loan, and we're not taking into account obviously the tax consequences that we'll run through as well. But it does give you obviously the ability to magnify your gains.
That's actually a good conduit, Andrew, into the tax, because I think that's the second reason why people consider this as a strategy. So with anything in Australia, if you're borrowing money and you're paying interest on that money, and the investment itself is designed to derive income, then that interest becomes tax deductible. So it's no different. And I guess the concept that most people are familiar with is negatively gearing a house. So you go to your accountant and say, hey, I'm paying too much tax. The accountant's like, I've got a solution. Tighten the noose around your neck, go and borrow $700,000, lose money on the investment, pay interest, you're out of pocket each and every month from a cash flow perspective, but in 30 years' time, the property would have increased in value 3 or 4-fold, which would have made this all the more beneficial. So using that example that everybody sort of knows and loves, and the accountants love to use that as a vehicle to talk about how they can minimize tax, but this is also another way because the interest that you are paying becomes tax deductible. So using that calculation that you did before of the $10,000 and the $7,000 and the $3,000 being better off, it's actually slightly different or more, because when you complete your tax return at the end of the financial year, it will reduce the amount of tax that you end up paying. Hopefully it results in a refund, but tax deductibility is probably the second reason why people tend to go into it.
Yeah. So tax deductibility and the ability to magnify your gains, as well as, I guess, maybe some of the other, smaller intangibles when you're starting to consider, hey, if I've got a portfolio that's only worth X and now I have a portfolio that's worth Y, by having more funds invested, I also have the ability to diversify more.
Correct.
Greater amount of funds that I can use to invest. And so I now have more options around where I can put that money, because simply there's just more money to be dispersed around. So it can allow you to have a little bit more diversification if that's ultimately what you're after as well.
Yeah, and look, ultimately, in order to have something that substantially impacts you and is life-changing, you need a big number.
Yeah.
So, you may get a 10% return on a portfolio of $10,000, which is a phenomenal rate of return, but it's only $1,000. And I don't say that lightly, but then if you do that same calculation on a $100,000 portfolio or a $500,000 portfolio or $1 million portfolio, completely different. So it ultimately results in all of those things coming together. But if you can have a bigger portfolio, then the absolute gains that you receive are a lot larger.
Yeah.
That's on the pro side. Obviously, we'll talk about it on the negative and the con side as well too.
I guess that's probably the perfect conduit, right? I mean, yeah, obviously if you're magnifying gains, you've also got the same thing in reverse as well. So in a declining market, you're now not just needing to, lick your wounds when you're talking about a decline in the investment value, but you're also now in a position where, hey, I've borrowed money, I'm magnifying my losses on the portfolio because I had $100,000, let's say I lost 10%, I've lost $10,000. Now I've got $200,000, I've lost 10%, that's $20,000 loss. And I've also paid interest over the course of the year on having the margin loan. So your magnification of losses is exactly the same as your magnification of gains on the positive side of things. So making sure that you've got, the risk tolerance and making sure that you've got the time frame to investment is really important, because while you can magnify your gains, you can also magnify your losses as well.
Yeah, and we'll talk about risk mitigation strategies as well, because this is absolutely critical in terms of what you were describing. You need to have a certain set of circumstances in order to be able to enter into this and to feel comfortable with it. We'll get into that a little bit later. The rise in interest rates. If you look at this, and obviously that was a pro on the other side in an environment where interest rates are declining, but the rise in interest rates as well too obviously changes the mix of what the return looks like once you factor everything into the wash as well too. So in our experience, these tend to work best in an interest rate environment that is relatively stable. You don't want to be bouncing around all over the place, because the idea and the concept behind this, like majority of the time that we're talking about investing, is long-term in nature. You're estimating or anticipating a set of circumstances, and you're kind of making an assumption that that's going to be consistent throughout the life of the investment. You want to be in a position where interest rates are stable, but identifying a con and a negative associated with this, that if you are in a position or if you are in a circumstance or a situation where interest rates are rising, it does work against you in this instance.
Yeah, exactly right. I think you also really need to, and probably the biggest con with a margin loan that, anyone really should be very aware of if you're entering into it, is a margin call. Mm-hmm. I think that's a scary scenario. I don't think anyone wants to be in that scenario where you actually do get a margin call, but it's something that's very different if you're not used to this type of investment, because it just doesn't exist in any other loan form really. So essentially what a margin call is your home loan, and I'll compare it to, let's say, a home loan. You buy property value is, $700,000. It's an LVR of 80% because you've, borrowed money against it, and property market collapses. All of a sudden that $700,000 property is down to, $500,000. And from a bank's perspective, it would be pretty scary because they would look at it and say, okay, you've got a loan on this property of, let's say, $500,000. I know that the numbers don't match up there on there.
Should have used $1 million on the calculation. Rookie mistake.
But let's say you've gotten to a position where your property is worth less than what the bank has given you.
Negative equity.
You've got negative equity. Now, from a bank's perspective, they are absolutely crap in their pants because if you decide, you know what, I'm giving the keys back, I'm stepping away, I'm going bankrupt, or you can't make your repayments, the bank is not going to be able to sell that property and get their money back. But there's no margin call when it comes to a home loan. As long as you continue making your repayments, whatever happens with the value of the property does not matter to the bank. Just keep making your repayments and they're not going to knock on your door. If you stop making your repayments, that's when they get concerned. A little bit different with a margin loan. So in a margin loan, and I'm going to be smarter this time around.
Good man.
$1 million is, let's say, invested. And let's say your LVR on that $1 million is at, say, 60%, right? So you've got a loan of $600,000 on that $1 million investment. Bank, or depending on who the margin lender is, they will set their own limits as to when there's a margin call. And maybe the limit on this is 70%. So if your $1 million portfolio decreases in value, so you haven't actually sold, you haven't actually done anything, it just decreases in value, and your LVR moves to 70%, the bank will actually come knocking on your door and the bank will say, hey, Mr. Client or Mrs. Client, you now have a portfolio that is in margin call territory. We're concerned. You can either do one or two things. You can either sell a portion of the portfolio, or we will force you to sell a portion of the portfolio to reduce your debt and bring you back to an acceptable LVR, or you can pull money out of your own pocket and put that into the portfolio in order to bring yourself back up to an acceptable LVR of 70%. So margin calls are really a critical thing, and we'll, run through mitigation strategies with this, but they are probably one of the most critical things in a margin loan, in that if the portfolio drops a certain amount and your LVR increases as a result of it, you need to either dip your hand in your pocket and put more money in, or you need to sell a portion of the portfolio in order to bring your LVR back up.
Yeah. No, well summarized, Andrew. The reason why margin calls, I guess, are known as a fairly risky financial product is in the set of circumstances that you've just described, that happens very, very quickly and you lose control. Yeah. So in the event that the stock market is going through a correction or what have you, or the underlying portfolio, there's an issue with some of the companies that you own, the lender who has issued you the margin lending product will move very quickly on that. And you only have, and it's based on product by product, but you only have like a couple of days to rectify it. If not, they're going to sell a portfolio from underneath you. Now, the worst part about this is you may be selling, or you may be doing that at the wrong time. I mean, if you've heard us on the podcast before, we talk about when markets correct, it's actually a time to be buying assets, not selling them. So I guess that's where the rap comes from in terms of it being a, quite a risky financial product. Some of the ways that we think about it from a risk mitigation strategy, that's probably a really good one to pivot into. But just a bit of a correction, Andrew. Don't know if you've ever nerded out like I have and read the loan contract on a mortgage. They're actually at-call products. So we haven't seen it. We don't see it. Let's be realistic.
Yeah, but it doesn't happen.
If the bank wanted to, for any reason, whether you're in a negative equity position or not, they could call it. they could say, we don't want to lend you this money anymore. And basically you either need to pay it all back or you need to refinance to another lender. So
We don't talk about that.
no, we don't talk. Well, look, no, the truth is,
It's never happened.
no, because property doesn't go down, Andrew. That's the reason why, right? So who'd ever be in a negative position with property? It just doesn't. Just
For all of those that are just listening and not viewing, that was absolutely sarcasm.
hopefully you could have detected that in my voice. Some of the risk mitigation strategies that we think about to take a product that, if you don't use it correctly, it can be quite risky. So, Andrew, some of the things that we think about, probably from my perspective, the first thing that I tend to think about is when we do borrow, we go conservative with our loan to value ratio. And we've got an internal rule in our business that we don't go above 50% loan to value ratio. So using that example that you had before, if somebody had $100,000 of a portfolio, we would then say, okay, borrow $100,000 and it's now a 50% loan to value or loan to equity portfolio. Same sort of thing if you're contributing additional money. If you borrowed $1,000 to invest in a portfolio, you'd also match it and contribute $1,000 of your own money. So you're keeping the borrowing ratio at 50-50. So loan to value ratio, in my mind, is probably one of the biggest ways to help manage the risk, because we really want to stay away from those areas and those buffers that the lenders set in terms of what then creeps into sort of margin call territory.
Yeah. I think the other one is making sure that you've got cash reserves. Is even more critical, and having an emergency fund and having cash reserves should be a part of every single strategy. But once you start to incorporate margin lending into a client's portfolio, or once you start to consider that, you now need to account for that in your emergency fund and say, hey, my emergency buffer needs to be larger and I need to have a greater a greater amount of funds that I can, pull out and maybe put into the portfolio in case there is a correction or in case I do need to top things up. So cash reserves become even more important when there is a margin loan around. Similar vein, not really similar vein, but the other thing that you really need to consider is how consistent is my income? You can invest in a portfolio and draw money out, and yes, there's a risk if, markets decide to take a turn and you need to withdraw some of the funds. But if you've got a margin loan associated with it, any drawing out of funds or any drawing from your investment portfolio, so sell down to move to your personal bank account to spend on bills or whatever it is, that's increasing your LVR. That's increasing your debt in proportion to the asset. So you need to make sure that you've got consistent income coming in, that you know what income's going to come in, and there's security around that income in order to be able to say, yep, this is something that I do want to partake in.
Yeah, so job security, because you don't want to be in a situation where you've got and entered into something like this, but you're in a volatile employment market and then all of a sudden you don't have any work.
And most of the time these things happen sort of in conjunction with each other, right? You consider someone being made redundant and at the same time, while redundancies are happening, investment markets are pulling back. That's a very, very common occurrence. So if there isn't that security of income, or if there's some, uncertainty with your job and redundancies and all of that stuff, both of those things can happen at the same time. You get a margin call and you've been made redundant because both of those operate in the same investment market, so to speak.
Probably from my end, Andrew, thinking about insurances, so making sure that your financial position is as bulletproof as it possibly can be through things like insurance. Specifically, the one that I tend to pivot towards is income protection, because consistency of income, like you were describing, making sure that you've got that income coming in to be able to service the debt and meet the strategy, is absolutely critical. And most of the time that we're talking to people, we are saying that your income or your ability to earn income is your greatest asset. So having income protection to make sure you are covered is absolutely critical in this strategy. And actually, from a financial advice perspective, we can't recommend a margin lending strategy unless we actually recommend a risk strategy as well too. We're not allowed from a licensing perspective because it really is critical that that's part and parcel of it. So you'll, assuming that this is of interest and you want to talk to us or a financial advisor about it, there'll be a risk recommendation that sits alongside it because there needs to be.
Yeah. I think also, one of the other things to consider, which can be, sometimes it happens accidentally, to be honest, but also it's some things, or sometimes people do crazy things to really try and accelerate their growth, and you really increase your risk, is double gearing. And what I mean by that is, let's say you've got a property, and let's say you've got some equity in that property. You use equity to invest in a share portfolio, and great, that happens. 1-2 years down the line, you then go down the route of, oh, hey, I've got this share portfolio that's now amounted to, I don't know, $100,000, $200,000. Let's take a margin loan against it. Now what has happened is...
It's all debt.
It's all debt. Yeah. You haven't actually utilized any of your own money. All you've done is just debt on debt on debt. So double gearing, I mean, that's, maybe sometimes how it happens accidentally, but I have seen before that some people will take equity out to invest in a portfolio and then take a margin loan on it. It's incredibly risky, and making sure, that's not to say that there's never a use case for it, but if there is a use case for it, you need to have an absolute bulletproof plan that sits outside of it. I think that there's probably very few scenarios where that is actually tenable, to be honest. But double gearing, if you're doing it accidentally, in that, hey, I've pulled the money out in equity, I've kind of forgotten that was debt when I pulled it out. And then you're starting to explore margin lending, can be an easy one to do accidentally. Yeah.
For me, last couple of things, Andrew, I mean, time frame to invest. This is not a strategy that you deploy for a year or two. This has to be a long-term strategy, like we do describe when we are talking to people about investing. It's not a short-term thing. It's a long-term thing. And the other thing associated with that is that you just don't invest in crappy assets, right? It's not speculative. You want stuff that's going to stand the test of time, true, tried, tested, over time, deliver results, continue to grow, pay that consistent dividends and income. You don't want to go speculative with borrowed money. It's a recipe for disaster.
Especially when there's a margin call on it as well, potentially. Maybe the long-term expectation is that it might go up. Who knows? Different story. But a short-term decrease in price can catch you out in the margin loan.
And then lastly, I think, Andrew, like anything, but specifically with this, get advice. This is not necessarily something I'd advocate for doing on your own. I think there's too many issues with it, too many things that can go wrong. It's easy to get caught up in all of the benefits associated with it, but it's easy to miss some of the downside. And I guess that's just human nature. We're always really optimistic about what's possible, but get advice, because it is an area that if you get right, it can be transformational. But if you get it wrong, it can be an absolute disaster.
Yeah, exactly. 100% agree. Bills, thanks again for another great podcast. Thanks to our viewers, now listeners, for tuning in. If you've got any questions on that, or if you wanted to reach out to either Billy or myself, details are in the show notes. Like, subscribe, and we look forward to catching you on the next one.
Thanks.
Thanks for listening today. If you have any questions on what we talked about, or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorized representatives and credit representatives of Acumen Financial Planning Proprietary Limited.